Hello everyone, welcome to EditUp and welcome to the Finance Current Affairs session. In today's session, we are going to discuss a very important news article of finance that is regarding the Monetary Policy Committee meeting that was held in the last September. Okay. And in this Monetary Policy Committee meeting, there were forecasts that has been done by the Monetary Policy Committee, as well as the decisions has been taken, the assessment on the global economy, the assessment of the domestic economy has been made. So all of this we are going to discuss in today's session, that what are the forecasts, what is the decision, what is the assessment of the global economy and the assessment of the domestic economy. But before starting with the session, there is a big announcement that the EditUp has launched the comprehensive guide for the RBI, NABARD and SEBI, where you can get all the information regarding the examination. Okay, this is the complete guidebook for the RBI Grade B. Here you can understand the previous cutoffs, the sources that you have to follow, the subjects that are there, the syllabus that is there. So all the information will be provided through a single book. You do not have to go to different links to different websites to understand the information, to understand about the examination. All the information will be provided in one book. The hierarchy that is there in the organization, the post that you will be joining, the role that you have, the role that SEBI has. All of this information will be provided through a single book. The sources, the cutoff, everything. So do download this book, and the link is given in the description box below regarding the comprehensive guidebook for the RBI, NABARD and SEBI, which will provide all the information to you regarding all the examinations. So I hope that you will get everything that you want to know and you will be understanding everything. Okay. So now starting with the news article, the RBI monetary policy updates that we are going to see in today's session. So on the basis of the assessment that the Monetary Policy Committee has done on the current macroeconomic situation and the coming macroeconomic situation, that what is the situation, what is the condition of the economy, on the basis of that, the Monetary Policy Committee has decided in its meeting that the repo rate will be increased by 50 basis point. That is, the repo rate was 5.40% and it has been increased to 5.90%. So by the 50 basis point, the repo rate has been increased. Okay. Now, when we talk about the LAF corridor, okay, this is the LAF corridor where SDF is at the floor and MSF is at the ceiling, and in middle is the repo rate. Now I hope all of you know that what is the difference between the SDF and repo rate. It is negative 0.25%. And what is the difference between the repo rate and MSF? It is positive 0.25%. Now the repo rate has been increased by 50 basis point. So what will happen, that the MSF will be greater than the repo rate by 0.25%. Okay, so and the SDF will be less than repo rate by 0.25%. So here you can see that the SDF is less than repo rate by 0.25% and the MSF is greater than repo rate by 0.25%. So if you know that what is the percentage of repo rate, you can easily know the whole of the LAF corridor, that is the Liquidity Adjustment Facility corridor. Okay, so this is the corridor. I hope you know the percentages of this corridor. The SDF is 5.65%, the MSF is 6.15%, and the repo rate has been increased by 50 basis point. That is, it has become 5.90%. Okay. And when the repo rate has been increased by 50 basis point, that means the SDF and the MSF has been raised by 50 basis point, because always the difference will be this. And when the repo rate has been increased, the SDF and the MSF has also been increased by that basis point. Okay, because the difference is same always. So now see why this repo rate has been increased. What was the need for increasing this repo rate? As you can see that from January 2022, the retail inflation has been greater than 6%. Now the RBI wants the inflation to be in between 2 to 6%. Okay, that is around 4%. The RBI or the Monetary Policy Committee wants the inflation to be around 4%, negative 2% and positive 2%. That is, it can be greater than 4% by 2 points and it can be less than 4% by 2%. Okay, but the RBI wants the inflation to be in middle of 2 to 6%, that is around 4%. Okay, now the inflation has been, from here you can see that from the starting of 2022 the inflation has been above 6%. That is, this is the upper tolerance level of the inflation, and the inflation is above this upper tolerance level. It was 6.01%, 6.07%, it went to 6.95% in March, then in April it was highest at 7.79%, then it was 7.04%, then in July it came to 6.71%, and it again rose to 7%. So seeing this trend of inflation that it is above 6% regularly from January 2022, it has been above 6%. So RBI wants to control this kind of inflation, as well as especially it is affecting the food inflation. In August, food inflation was the one that was very high. So to control such kind of inflation, the RBI has raised this repo rate, so that when the repo rate is what? Repo rate means this is the rate at which the commercial banks or the banks will get the loan from the RBI. So when the commercial banks or the banks are getting the loans at higher rate, the banks will be getting the loan from RBI. So the banks will also provide the loan at higher rate to the consumers. So if we get the loans at higher rate, so we will not want to get much loan, because now we are getting high interest rate. We have to pay high interest rate. So the cost of borrowing has increased. Okay. So the cost of borrowing has increased, and when the cost of borrowing has increased, we will not want to have much loan. The consumers will not want to get much loans because the cost of borrowing is high. So the borrowing will reduce. When the borrowing reduces, the demand will reduce, because why we are borrowing? We are borrowing to buy the houses, to buy the cars, to buy the luxuries, to buy the goods. So when the borrowings reduces, that means our demand for the goods will also reduce. So this is the whole concept of increasing the repo rate, to decrease this inflation, to decrease the demand. When the demand decreases, the prices will also decrease. Okay. So now, see, the decision are in consonance with the objective of achieving the medium-term target of keeping the inflation in between 2 to 6%, that is around 4%, in the band of plus minus 2%. Okay, while supporting growth. So see, this has already been expected. The market experts expected that the Monetary Policy Committee will take this step of increasing the repo rate, and this has been corrected. Okay, so the market experts expected the Monetary Policy Committee to raise the repo rate by 50 basis point in this meeting to tame the raging inflation. You can understand that the inflation is rising very fast. Okay, it is going down, but it is again increasing very fast. As well as the rupee has also been falling. And it is very low. Currently, when I saw the latest data, it was 82.82. So $1 was this much rupees. So you can understand that it is above 80 rupees. It is above 82 rupees that has gone. So you can understand that, seeing that how fast the rupee is losing its value against dollars. We have to pay more and more rupees, more rupees for $1. Seeing the depreciation that is happening of the rupees, the RBI took this step that we need to reduce this demand, so that the imports happen less also, so that we consume the imported good less. Okay, when the imports will be less, when the demand for the imports will be less, that means the dollar will not be as strong. Okay, that means we want to reduce the imports, we want to reduce the demand for the imported goods. Okay, when the demand for the imported goods, for the American goods will be less, then what will happen? That the dollar value will also be reduced, because we will be demanding less dollars, and when we will demand less dollars, that means the value of the dollars will also reduce. Okay, that's why the RBI wants to control the demand, control the imports also in this way also. So I hope you have understood this point also. Now coming to the assessment of domestic economy. Real GDP growth for 2022-23 is projected at 7.0%. That is the real, it is expected, it is projected by the RBI that the GDP growth, the real GDP growth will be 7% for the financial year 2022-23. Before, in the previous Monetary Policy Committee meeting, it has been projected, it has been forecasted that the economy will be growing at 7.2% in the 2022-23 meeting. So this meeting was held in August 2022, and in that meeting, Monetary Policy Committee meeting, it was projected that the economy will be growing at 7.2%. This is the real GDP growth. But now in this current meeting that was held in the last September, in the late last September, it was forecasted that the real GDP will be growing not by 7.42% but 7%. So the real GDP growth forecast has been reduced from 7.2% to 7%. Okay, so you have to remember that the real GDP growth forecast has been, or the projection has been reduced from 7.2% to 7% in the September 2022 Monetary Policy Committee meeting. Okay, so here you can see that in the quarter 2 it is expected that the economy will be growing, the real GDP growth will be 6.3%. Then in quarter 3 the data is here, the quarter 4 the data is here. For quarter 1 2023-24, that is for the next financial year, quarter first, that is from April 2023, the 3 months that are there, it is projected that the economy will grow at 7.2%. Okay, so in the next quarter we are expecting that we will grow by, in the next year, financial year, the first quarter, we are expecting that the economy will grow at a good pace. So overall system liquidity remained in surplus, with the average daily absorption under the liquidity adjustment facility easing to rupees 2.3 lakh crore. So what the RBI is doing, RBI is continuously trying to decrease the money supply in the economy. Okay, the money supply, the liquidity is very high in the economy, and that's why the RBI is taking the steps to reduce this money supply in the economy so that the demand can be reduced. When we have too much money in our hands, what we will do? We will demand. We will demand in the domestic economy, we will demand the imported goods also. That's why the RBI wants to absorb this excess liquidity, to take the excess liquidity out of the system so that the money supply can be reduced, the money in the hands of the people can be reduced so that the demand can reduce and the inflation and the depreciation can be controlled. Okay, so now assessment of the domestic economy, continuing with it, the CPI inflation rose to 7% in August 2022. In July it was 6.71%, but in August it increased to 7%. So the CPI inflation, the retail inflation, it increased in August to 7%. Okay, from the previous month. As food inflation, especially the culprit was what? The culprit was the food inflation. The food inflation was pushing the retail inflation. As well as the fuel inflation moderated with reduction in kerosene prices, though it remained in double digits. The core CPI, that is the CPI that excludes the food and fuel inflation, remained sticky at heightened levels. Okay, so now inflation is projected at 6.7% in 2022-23. This is the same projection that has been given in the previous Monetary Policy Committee meeting also. So here there is no change in the inflation projection. Okay, in the inflation rate projection there is no change from the previous Monetary Policy Committee meeting decision or the forecast. So here with quarter 2, in the quarter 2, that is from July, April, May, June. This is the first quarter. From July, August, September, it is expected that in the second quarter, in this quarter, the inflation will be 7.1%. So you can understand that it is very high. It is very above the 6% mark. Okay, that the RBI is upper tolerance level is. In quarter 3, it is expected to be around 6.5%. In quarter 4, it is expected that in the last quarter of the fiscal year of 2022-23, the inflation will go down from 6% mark. Okay, so it will be around 5.8%. The CPI inflation for quarter 1 of the 2023-24, the projection is 5%. So in the next year, in the first quarter of the next year, next financial year, we are expecting that the inflation will be controlled in a good manner. Okay, so now this is the whole highlights of the RBI Monetary Policy Committee meeting. The repo rate has been increased by 50 basis points. The GDP projection has come down to 7%. It was given 7.2% in the previous Monetary Policy Committee meeting, and in the current meeting the projection has been reduced of the GDP, real GDP growth, from 7.2% to 7%. The inflation, it has been, the projection has been remained same for the financial year 2022-23, that is the financial year 23. Okay, that is the current financial year that is here. So here you can see the policy rates has been increased. This is the previous rates and these are the new rates. So this is all that you have to remember for the exam. Okay. So assessment of the global economy. Now, why this inflation is coming into our country? Why can't we control it? Because it is not the only factors or the variables of the economy are changing, but the factors and the variables in the global economy are changing. How? The global economic activity is weakening under the impact of the conflict that is in between Russia and Ukraine. The geopolitical tensions are there, and due to which there is aggressive monetary policy actions and the stances that has been taken by the world. So the world is trying to, the most of the monetary policies, most of the reserve banks or most of the monetary, the authorities of the countries, they are trying to increase the repo rate. They are trying to increase their rates, that is the interest rate. And when they are trying to increase the interest rate, they are taking the aggressive measures to increase the interest rate. When the interest rate is increasing in the developed countries, what will happen? That the money will flow where the interest rate is high. Because why they will save in India when they can save where the interest rate are very high? Okay, so the savings, the money, the foreign exchange is going out of the countries, of the emerging economies, of the small economies as well as the developing economies, and the money, the savings are going to the developed economies where the interest rate is growing very fast. Okay, so financial conditions tightened. Global financial markets are experiencing surges of volatility. There is too much volatility. The interest rate are rising in one country, the money is flowing to that country, especially the money is flowing to dollars. The money is flowing to dollars because dollars is a strong currency, and currently the volatility situation, most of the peoples, most of the investors are afraid, and that's why they want to invest. They want to save their money in dollars, as well as dollar is appreciating. It is getting more and more strong against most of the currencies. So there is much trust that is put in dollars by the investors, and so the money is going for investors, for the dollars, and that's why the money is getting out of the emerging economics of the developing economics, with sporadic sell-offs in equity and bond markets and the US dollar strengthening to a 20-year high. So you can understand that from our bonds, from our equities, from our financial market, the money is going out, that is to the dollar that has become very strong, or the economies that have very high interest rate. Emerging market economies are facing intensified pressure from the retrenchment of portfolio flows. That is, the money is not coming to the country, it is getting out of the country. The foreign currencies are getting out, or the foreign investment is getting out of the country that has been invested in the financial markets. Okay, the currency depreciation is happening. You can see the reserve losses and the financial stability risk are there. The global inflation shock is there due to the war, due to the COVID. The supply chain disruptions were there. The supply was not happening very smoothly, and now due to this war, again the supply is not happening very smoothly, and due to that the inflation is getting higher and higher, and it is increasing very fast. Okay, so you can see this is the global economy situation, and due to that the Indian economy is also affected, and most of the economies are getting affected. Okay, so I hope now you can easily answer this question. This is the first question for today, and this is the second question that I hope that you can answer now. Okay, so thank you very much. If you want to get the PDF of this session, you can join our Telegram group, as well as keep following our YouTube channel. You can subscribe to the YouTube channel to get the videos, okay, so that you have more information for the examination. So now thank you very much. If you have any query, you can mail us here, or you can contact us through this number. Thank you very much, everyone.